to war. And then I'm walking down the street in New York City on a beautiful spring day, and it hit me. I am in a war. I am in a war. And there are evil forces that I am fighting right now, and I better understand that. And I realized I was going to be alone for 2 weeks, all alone for the first time ever in my house for 2 weeks. And I wasn't happy about it, I wasn't sad about it. But what happened is this. The Holy Spirit hit me over the head with a business idea.
They gave you what?
LSD.
Castration! Double castration!
All right. Today is Monday, March 22nd, and this is a post-market review for the stock market activities today. We saw a bounce today in the Nasdaq and a bear market rally in certain names that dropped over 20% from the highs, the likes of Tesla, but the close was not so hot so. The close was a little weak. It shows that there is no confidence in this bounce. And the reason is that yields did not retreat meaningfully. If anything, it is a pause before resuming the rally in yields. And if yields continue to rally higher, then the trajectory for the Nasdaq and the Mania stocks is down until and unless the Federal Reserve does enact an actual policy to address the rise in Treasury yields. We will talk about that and a lot more, and we will also cover the comical price target for Tesla from ARK Invest and Tesla witch Cathie Wood, because at this point it is beyond any reasonable explanation, it is beyond any logic, it is becoming quite laughable if it wasn't sad. So we'll go over what's going on with ARK Invest and their insane price targets. We will also talk about Tesla during the headlines of the day segment, specifically in corporate news, because we have some bad news here for the Souffle. But I know, what about the robo-taxis, bro? Yeah, where are they? Where are the robo-taxis? I thought that was coming last year. Oh, it got delayed. And that's why we added another $100 billion to the stock's valuation based on delay optimism. Anyways, this will be a fun and a wild ride. So buckle up your seatbelts and here we go. The Dow Industrial Average closing in the green by 103.23 points, or a gain of 0.32%. The Nasdaq closing in the green by 162.34 points, or a gain of 1.23%. The S&P 500 in the green by 27.49 points, or a gain of 0.70%. And what about the sector's performance for the day? Leading the pack and capturing the gold medal, technology at number 2 for the silver, healthcare, and at number 3 for the bronze, real estate. Meanwhile, the laggards of the day led by energy, financials, and industrials. So we are seeing the inflationary trade retreating, and that retreat started last week. If you are looking for a dip in the inflationary trade, you might be getting it very soon. Moving on to the futures market performance. What do we have here? Muted activities for crude oil, closing pretty much flat for both the WTI and Brent. Meanwhile, in softs, we have another day of massive gains for lumber futures, over 4% gains and closing at 1,000 once again. We also saw gains for coffee and cocoa. Meanwhile, the laggards, led by sugar, declining by about 1.5% today, and OJ losing about 0.5 percentage point. Meanwhile, cotton futures remain muted. And what about metals? Muted activities for gold, but we saw declines for silver, platinum, and palladium. Meanwhile, the gainer of the day, rebounding once again, Dr. Copper, closing with gains a little over 0.5 percentage point. What's going on with meats futures? Gains across the board, led by lean hogs, feeder cattle, and live cattle futures. Meanwhile, what about grains? Muted activities across the board, and the reason is we saw muted activities for the US dollar. The triangle of inflation expectations in the futures market consists of copper, lumber, and grains. Today we saw lumber higher, copper higher, grains muted, but the trajectory for the triangle of inflation is higher. And if we see declines in the US dollar, that will embolden the move higher once again. Moving on to the big casino, the options market. Let's see what's going on here. Some of that stimmy money is starting to show up in the options market, not by a lot, but it is notable. And today we saw Apple closing at number 1 with a little over 1 million contracts. About 72% of those were calls. And at number 2, Facebook with about 600,000 contracts. About 73% of those were calls. And at number 3, Tesla with a little over 500,000 contracts. About 60% of those were calls. Moving on to the unusual activities that took place in the options market today, starting with the ticker RCL. This is for Royal Caribbean. As you know, I have turned bearish against the reopening trade, and I started fading and shorting certain names. And the reason is the prices went out of whack, assuming a clean, flush reopening, and we don't have a guarantee of that at all. We have the COVID virus surging again in Europe and in certain states here, and there are no guarantees that the reopening will meet the expectations from the moves that took place in some of these stocks. And here we have a trade of somebody fading the move in cruises, specifically Royal Caribbean, by buying the 84 puts expiration date March 26, meaning this upcoming Friday, with expectations that the name will decline over 5.5% by then. They paid about 45 cents a piece to enter this trade, which brought the total all the way to $500,000. What about the ticker SPRT? This is for support.com. Who the hell knows? And who the hell cares what this company is, what it does, because it is a Mania name, it popped higher significantly, and now they're betting on more gains to come. And if you've been following me for a while, you know that when I see these kind of moves in the options market, I buy the stock, specifically if the stock is trading under $10. Because what is the point of paying more for the options when you come buy the actual stock? The premiums for these options are highly elevated. It doesn't make sense whatsoever to play the move via buying call options. You buy the stock and you sell call options, and then you dump the stock with a profit and you collect the premium from selling those calls. But anyhow, in this case, they're playing it via buying call options, specifically the 7.5 calls, expiration date April 16th, with expectations that the name will gain over 6% by then. They paid about $1.50 to enter this trade, which brought the total all the way to $1.3 million. What about the ticker RLX? This is for RLX Technologies. It's an e-cigarette stock. The name was down significantly today due to news of regulations on e-cigarettes from the Chinese government. But somebody's betting on a rebound here by buying the 12.5 calls, expiration date April 16th, with expectations that the name will gain over 22% by then, and they paid about $1.35 a piece to enter this trade, bringing the total all the way to $1 million. What about the trade for the ticker AMRS? This is for Amiris, and this is a biotechnology company specifically for the beauty and healthcare products sector. The name has been a hot trade, and somebody's betting on more gains to come by buying the 25 calls expiration date May 21st, with expectations that the name will gain over 9% by then. They paid about $3 a piece to enter this trade, bringing the total all the way to $1.5 million. Continuing with interesting trades. What about the trade for the ticker JBHT? This is for JB Hunt. They're buying the 170 calls, expiration date April 16th, with expectations that the name will gain over 7% by then. They paid about $1.50 to enter this trade, bringing the total all the way to $500,000. I do like this trade for JB Hunt. What about this trade for the ticker CRSP? This is for CRISP, and this is a biotechnology that is hot with the Mania that Cathie Wood names. And it's been up, it's been down, it's a wild ride for this name. But somebody's betting for more upside here for Chris by buying the 155 calls expiration date April 16th, with expectations that the name will gain over 16.5% by then. They paid about $2.60 a piece to enter this trade, and that brought the total all the way to $800,000. And what about this trade? For the ticker UPST, this is for Upstart Technologies. It's a fintech startup, and it's been a hot stock, gaining over 100% in the last few days. And somebody's fading the move, calling a top here by buying the 140 puts, expiration date April 16th, with expectations that the name will decline by over 7% by then. They paid about $20 a piece to enter this trade. Now, options are sold in contracts. Each contract has 100 options. So when you see $20 a piece, that actually means $2,000 per contract. So this has to be a high conviction bet from somebody who's calling the top. Because all in all, the trade cost them about $6 million. And they have all the way to April 16th for this trade to work. Moving on to the headlines that shape the day, starting with macro news. Here is a headline coming near you. In the US, Turkey's lira plunged to near its all-time low after markets opened following President Erdogan's shock weekend decision to oust a hawkish central bank governor and install a like-minded critic of high interest rates. Sounds familiar? Because this is what we're doing. Print to oblivion, and the result will be destroying the local currency. And now you see in Turkey that you don't only have an inflation problem, but the local currency is being destroyed. This is what happens when you have a misguided economic policy. And this push for lower and lower interest rates will cause more inflation and destroy the Turkish lira. And you saw the Turkish ETF down by over 20% today. And this is just a little teaser for the Federal Reserve to get the memo. If you continue in this path, this is exactly what's going to happen in the United States of America. But of course, we're not going to get the message because here it is. And this is from CNN Business. Without modern infrastructure, the US cannot create decent jobs, social justice, or climate safety. After decades of delay, now is the time for President Joe Biden to go big, writes Jeff Sachs for CNN Opinion. They just passed $1.9 trillion. And by the way, that is money printed out of thin air. Now they want another bill, over $3 trillion of infrastructure spending. You know, every president since I was born been talking about infrastructure this, infrastructure that, and nothing ever happened. The highways are garbage. The airports are garbage. We don't even have railroads in this country. So where did this whole infrastructure spending money went? That's a good question, isn't it? The other thing is we have an inflation problem. And these geniuses, these mad scientists, are thinking about adding another $3 trillion plus bomb to the national debt and to the budget deficit. Meaning, and by the way, I do think that they will pass this bill. It might not be $3 trillion, it could be $2 trillion, but it will get passed. And let's say that the bill passes with a price tag of $2.5 trillion. I can tell you right now, $1 trillion will go into actual infrastructure spending. Meanwhile, the other $1.5 trillion will go into the pockets of Wall Street and contractors, administrative costs, bureaucrats' pockets, etc., etc. Meanwhile, it will push inflation to explode out of control. Yields will surge out of control, and the stock market will get destroyed. And why do I say that this bill will be passed? Because the trajectory for yields and interest rates are higher. So all of a sudden now the government is scrambling to get advantage of low interest rates before they shoot up higher. And therefore, this bill will be passed, and it will add a massive fuel to the fire of inflation. And here it is. Biden's closest advisors have ties to big business and Wall Street, with some making millions. Now, we call the Biden administration in this show the BlackRock administration, and people get mad at me, calling me a MAGA guy. Meanwhile, last year, when I was making fun of the Goldman Sachs administration with Trump and slimy Mnuchin and the propaganda minister Kudlow, I was called a socialist and a communist. So it's funny how these things work. At the end of the day, you are a donkey if you believe in this team blue, team red kind of politics. Because at the end of the day, there are no parties here. It is a one-party system, the Purple Party, and their job is to screw you every single day. But let's see what this article is saying about the Biden administration, aka the BlackRock administration. This is one of his advisors, was previously the global head of sustainable investing at, surprise, surprise, BlackRock. Before becoming the head of the National Economic Council, while at the investment firm, Deese's disclosure shows he made over $2.3 million in salary and bonuses. His disclosure also suggests that through BlackRock's restricted stock plan, Deese could have made an additional $2.4 million. And obviously these people have your interest in mind, the average American bum, right? Moving on to yields. What's going on here? What about the 2 to 10 year spread? Take a look at this chart and take a look at it carefully, because we are seeing a steep, very steep move higher, signaling a change in regime, a change in the trajectory of the yield curve spread. Now, take a look at the year 2014. What happened then? The spread between the 2 to 10 year starting sliding lower and lower and lower. That was the top right there. Ask yourself a question. What happened to oil and financial stocks since 2014? Not so good. The XLF, the XLE been lagging the market. But now that we are seeing a change in regime, the change in trajectory for the yield curve and the spread between the 2 to 10, that is a solid, significant indicator that energy and financials will outperform the rest of the market. And therefore, I'm saying if this trajectory continues upward, regardless of the breaks and the pauses, that means the financials will continue to outperform, and buying the dip in financial names makes a lot of sense. And it's not just financials, by the way. It is value names. Here is the US value versus growth in blue and the US domestic liquidity in orange. And as you can see, there is a correlation in the relation between liquidity and the outperformance of value stocks. And usually what happens is that liquidity acts as a leading indicator to the upcoming outperformance of value stocks. And as you can see from the chart, the US liquidity is projected to skyrocket this year and the upcoming year, meaning that the outperformance of value stocks over growth stocks just started. The question is, are you paying attention or not? Here is more in macro news. In the morning, we received data regarding existing home sales. And here it is. Existing home sales fell sharply in February as supply dropped by the largest amount on record. And of course, the deflationary crowd will tell us that, oh, don't worry about it because the supply chain, don't worry about this transitory inflation because we will start building houses digitally. The supply will come out digitally. And we will start selling these houses as NFTs, and we will solve this whole shortage in housing. But out of La La Land and back to reality. Here it is. The supply of homes for sale fell 29.5% year over year, the largest annual decline ever to 1.03 million homes. Moving on. What about taxes? What's going on with Uncle Sam? Uncle Sam's not happy with a lot of rich folks because here it is. The richest Americans don't report at least 20% of their income to the IRS. New research suggests. Once again, the rich getting away with freeloading. They're not paying their tab. The corporations don't pay their tab. And the burden of taxation is left on the poor and the middle class. And of course, these are the same people who would wear an American flag pin and flash their quote-unquote patriotism all over the place and giving the rest of us lectures about patriotism and the duty to country and all that garbage. You want to be a patriot? Pay your damn tab to the country. Because Uncle Sam could give a rat's ass about your stupid American flag pin or hanging a giant American flag in your yard. All of that stupidity, Uncle Sam could give a rat's ass about that. Uncle Sam wants to get paid, baby. Uncle Sam wants you to pay your tab. So once again, please don't lecture us about patriotism and duty to country and all that garbage until you start paying your damn tab. Ask not what your country can do for you, but what your wallet can do for your country. Moving on to sentiment news. You know, since the 2020 stock market mania started, we saw a new phenomenon. It's a cult-based investing. And it goes as the following. You have a bunch of cult leaders. You see them in the picture right now, led by Reverend Elon Musk. And we see crybaby Davey Barstool and Tesla witch Cathie Wood. And lastly, we have the SPAC Jesus, the scam artist of the century, Shamath Palate Potato Tequila. Individual investors often say they could not care less about the depth of analysis behind the trade. Of course they don't, because they put the blindfolds on and they stampede running Naruto style, heads first, asking questions later. And of course, when the trade starts going the other way, all of a sudden they start asking questions. Oh, what happened? Oh, we invested in fraud? We didn't know that. And here it is. If their icon is buying something, they will throw money at it too, because they're a bunch of donkeys. And all of these scam artists that you see in front of you, Reverend Elon, Crybaby Barstool, Tesla Witch Cathie Wood, Spaccaria, they're all doing the American thing, the classic American thing, which is milk these donkeys for all of their worth. When you see dumb money, a bunch of zombies with their wallet wide open, you gotta take that cash and ask questions later. And here is one of their quote-unquote icons, Tesla witch Cathie Wood. You know, Mama Cathie likes to gamble. She has a gambling habit and she invests based on the tips from the Holy Spirit. And the Holy Spirit this time around whispered to Mama Cathie's ears and he said, go crazy. Give the craziest price target prediction ever. Just to make headlines, because who cares at this point? You already have no shame, so just do it. Cathie Woods, ARK Invest Management expects Tesla stock to hit 3,000 by 2025. Up from its current price of 655. At that price, the company could be worth almost $3 trillion, or more than 10% of the current GDP of the entire United States of America. Sounds reasonable, right? And when you do that kind of crazy predictions, 3,000, just make it 5,000. Make it easier. Why not? Go 5,000. Go 10,000. Make it a little bolder. Cathie Wood, that's kind of weak. You know, when you go 3,000, you're playing it as, oh, maybe I did some research that led us to this conclusion. But from reading the research, we know that there is no research. It's all garbage and throwing buzzwords here and there just to give you the illusion that ARK Invest and Cathie Wood actually did some smart, sophisticated calculations. They throw words like the Monte Carlo model. And let me tell you, I worked as a financial analyst in the biotech industry, where you had to write up valuations and forecasts for companies with no revenue. So it is even more challenging. And I went over Tesla witch Cathie Wood's price prediction and quote-unquote research, and I can tell you, it is all garbage. Spare us the quote-unquote research and just tell the truth. You dealt the tarot cards and they showed you 3,000. There is no science, there is no intelligence whatsoever involved in coming up with this price target. But I know what the culties are gonna say. Oh, but last time they made fun of her and look at that, the stock went higher anyways. Nobody believed Cathie Wood before. And she was right, yada, yada, yada. I'll give you 5 minutes to figure out what the difference is between now and then. Okay, 5 minutes is too long. Let me tell you right now. Back then, you could support an insane valuations from Cathie Wood. And the reason is the macro environment was supportive. Number one, you had historically low interest rates, and that supports a lot of risk taking in the equities market, and valuations don't matter under a regime of low interest rates. Number two, there wasn't any competition for Tesla. The competition was pretty much non-existent. Number three, the cost of raw materials. We're talking about lithium, cobalt, nickel. That was all dirt cheap back then. Now we have the opposite picture. We have an explosion higher in raw materials costs, whether we're talking about nickel, aluminum, cobalt, lithium, all exploding higher. In addition, Tesla has a lot of competition coming up from VW, Toyota, Ford, GM, Neo, Xpeng, all over the place. Everybody and their mothers is building an EV somewhere, somehow. And of course, we know that the regime of low interest rates is coming to an end, and interest rates are rising higher due to inflation expectations. Meaning, you should take this prediction and throw it in the garbage, because Cathie Wood and her cult followers are about to commit suicide. And what about Chamath Predatoria and his SPAC scams empire? Here it is. Hedge funds are ramping up bets against Chamath Potato Tia SPACs and have already taken home $40 million this year. Here is a detailed look at the wagers they're making. I will spare you the details and tell you this. Bet against all of these scam SPACs and go to sleep like a baby, because you're betting against the Chamath cult, because even Chamath himself is betting against his own donkey followers. He's cashing in millions and millions and millions of dollars of fees from all of these SPACs, and he's dumping on their little heads. Case in point in the Virgin Galactic episode, and there are more episodes to come. Chamath knows what he did. He created scams, money sinkholes to exploit the mania and become richer while selling a bunch of lottery tickets. And now the drawing date will come, and we know that the only winner will be Chamath himself. Meanwhile, his cult followers will lose everything, because this cult-based investing is sort of like a pyramid scheme. The earlier entrants to the trade reap all the benefits, and then the chasers, aka the retail traders, are the one chasing the mania at the end, and they get the bad end of the deal, and they become the dumpies, where the earlier entrants dump on their little heads. This ARK investing, SPACs, even Bitcoin, they are all pyramid schemes, because they depend on recruiting more investors to push these prices higher. Not more revenue, more profits, more growth. It is more people, more traders and investors pushing the prices higher. Classic pyramid schemes. And here is more in sentiment news and the mania going on in the stock market right now. Retail investor activity has remained strong, and online broker account trades are very elevated. This is the daily average trade. And at first I looked at the axis and I'm like, wow, they're making 300 trades per day as average. But no, they're making about 10 trades. 10 trades. We're not talking in a week, in a month, in a year. We are talking 10 trades a day. This is extreme. This is something that we have not seen ever before. It makes the dot-com bubble looks like a baby. This is extreme mania. I don't recall ever in my entire trading career that I made 10 trades in a single day. Never happened before. Even day traders don't make 10 trades per day. This is unbelievable. But wait, there is more. What about the global equity flows? You know, rates are rising and we have all these concerns, inflation, yada yada. No. Just put your blindfold on, open your wallet, and throw it all in the casino. Global equity flows in 2021 so far surpassed $1.5 trillion. Think about that. It's not their money. All of these firms dumping money at the market. It's retirees, pensions, etc. So the thieves don't care about deploying this money in the market right now when we are in a bubble market and we have interest rates rising higher. A very lethal formula. It's not their money, so they're going to gamble with it anyways. When the market crashes, whoops, pensioners, retirees, well, the market goes up and down, you know, can't do anything about it. And here's more in sentiment news. What are they buying, by the way? Are they buying good stocks? Solid stocks? Not at all. Weak is winning. US firms with dicey balance sheets eye best quarter versus those with strong ones. Yeah, I know, because when yields are rising higher, interest rates going higher, you want to pick the weakest balance sheets with the highest debt, because with interest rates go higher, the interest you pay on your debt goes higher. And if that happens, then the company will have to declare bankruptcy and they don't have to worry about the debt anymore. You see? You see how smart we are? Once you declare bankruptcy, now you don't have a debt, and boom, to the moon, bro. And are market participants being at least a bit careful, buying protection whatsoever? Of course not. Here it is. The S&P short interest is at record low, meaning that you're not going to have any short covering rallies anymore. There are no shorts, nobody's buying protection whatsoever, and you know what this means? That if the market goes down, you're not going to have shorts to cover for your ass. And the last time we saw that was, surprise, surprise, the collapse of the dot-com bubble. What about the GameStop mania and the YOLO stocks? Interest in GameStop appears to be waning as Reddit conversations and trading volume have declined. Don't expect people to use their stimulus checks to buy GME, one analyst says. But the other 99 analysts say that the mania will continue and they will chase GameStop stock indeed. And by the way, GameStop reports earnings tomorrow, and the options volume exploded higher, and they are expecting a move of over 40% up or down after GameStop's earnings. Grab your popcorns. And with all of this mania going on in the market, the reckless, irresponsible behavior by market participants, here is Goldman Sachs, the geniuses that they are. Goldman Sachs Group strategists say many of the characteristics of a dangerous bubble are absent from global stocks. And of course, we all know the reputation of these Goldman Sachs quote-unquote analysts, because rumor has it that the entire team at Goldman Sachs missed their appointments with the optometrist. Oh, where is the bubble? I can't see it. I can't see a market bubble. I can't see inflation. And the earth is flat, by the way. And what about the 21st century's tulip mania? Oh boys, you got some trouble here because Papa Jerome himself is coming after you. Powell calls cryptocurrencies not really useful stores of value and says Fed will move slowly. So Jerome is being kind enough to give you an advance notice that he's about to crash Bitcoin, so make your moves accordingly. And here is more. The Fed is getting closer to creating a digital currency that could reduce payment frictions and potentially eliminate huge sources of revenue for Wall Street firms. Now, I don't have any cash, but I have money in my card, so isn't that already a digital currency? And here is the last bit of sentiment news. You know, we have new investors in the market since the March bottom of 2020. And a lot of them are confused. They're saying, wait a minute, if the economy is about to be hotter than ever, then how come the stock market doesn't like that? What are you talking about? But somehow they forgot to ask the same question last year when the economy was in shambles. We had the deadliest pandemic in a century and the stock market was going higher and higher impulsively. No questions were asked back then whatsoever. Oh, that was normal, right? Stocks only go up. But now they're asking questions when the tables are turned. So let's answer the question. Can the stock market crash during an economic boom? It's rare, but it has happened before. Inflation can be harmful to the stock market, but it is hard to imagine investors selling their stocks in the midst of an economic boom. First of all, we know that it is a fugazi economic boom. It's a zombified economy that is being stimulated by steroids, aka the cocaine, the stimulus. Has the stock market ever crashed as the economy soared? It is rare, but it has happened before. Averages can often hide outliers, and one outlier here was 1937. Real GDP growth came in at over 5%, but the S&P 500 finished the year down 35%. However, one of the reasons stocks fell so hard that year is that the economy started to slow down by the end of the year, which led to a recession that lasted until 1938. The highest growth with a down stock market came in 1941, when GDP was up double digits year over year, while the S&P 500 finished the year down almost 11%. This was an instance in which investors were spooked from World War II. And here is the take. There is one caveat that may apply with today's environment though. While it is rare for the stock market to fall during a booming economy, it is also rare for the stock market to boom in the midst of a nasty recession like it did in 2020. So once again, we are in the upside down world where good news is bad news and bad news is good news. Because why? Because the market has become, say it with me, a cocaine addict. And the cocaine is fiscal and monetary liquidity. I think we just had an earthquake here. Anyways, no biggie. Back to the cocaine. The market goes higher if the supply of liquidity and easy money policy continues. But once you cut that supply of liquidity and easy money, funny money policies, all of a sudden you have a market that has to stand up on its own feet. And it is not able to do that because it has been surfing the wave of QE for years and years and years. And the adjustment will be painful. And therefore, the market could crash under one of the hottest economies we're about to have. But remember, it is a stimulated economy. It is artificially inflated. So underneath the facade, there is a very damaged economy. Moving on to corporate specific news, starting with Tesla, the Souffle. And oh boy, the Souffle has a lot of troubles. China bans Teslas from the military complexes and housing compounds because of concerns about sensitive data being collected by onboard cameras. Of course, the Chinese are worried that Reverend Elon Musk is spying on them. Meanwhile, they're actually spying on him. They bugged his factory over in Shanghai. They stole all the important information, and now they're building their own cars. Xpeng was pretty much stolen from Tesla. But the Rev continues to tweet memes and pump Dogecoin. Meanwhile, he is not paying attention to the giant piano hanging over his head, the time when the Chinese will decide to kick Tesla out of China. Because why do you think that they allowed Tesla to build a factory in Shanghai and dominate their markets? Did they do it out of the goodness of their heart? Of course not. They did it to get access of the proprietary technology of Tesla, steal it, and make a copycat, and then flood the global markets with cheap competitors, and therefore destroying Tesla. And he was Reverend Elon. And he is strongly denying that Tesla would ever use a vehicle's technology for spying, except when the CIA asked him to do so. Otherwise, God forbid, all of the dirty laundry that the CIA has on Elon Musk might accidentally leak to the public. And we all know who the CIA agent who collected that data. Of course, the Chinese did not like what Reverend Elon said. They did not take his assurances for real. And then he started making mockeries and funnies. Elon Musk responds to spying concerns in China. Trust us, we are just like TikTok. Tell me again that this is the $3 trillion company that might lose its Chinese market, but somehow it's worth $3 trillion. And this mania is becoming concerning even to the culties themselves. Tesla bulls see glass half empty scenario as China reportedly restricts some vehicle use. I think in itself, it is not a big deal in terms of the impact it has on Tesla, but it is a bit of a shot across the bow from Beijing that Big Brother is watching. And this is from Whitbush Don Ivis, a longtime Tesla bull. You know, the same Dan Ivis of Super Thankful. The broader worry, he says, which has always been percolating among investors, is if Tesla started to get too successful in China, would they ever start to get their wings clipped, adds Ivis? The fear among the bulls is that they just don't want to see this snowball. But you know what they say, when it rains, it pours. More and more troubles for the Souffle. Tesla whistleblower complaint about solar fires is part of evidence in federal safety investigation. The U.S. Consumer Product Safety Commission is considering as evidence a former Tesla employee's complaint about how the company managed and communicated about fire risks and defects in its solar installations. It has also interviewed that employee, Stephen Hinkes, who was then a Tesla solar field quality manager. Hinkes has also sued Tesla for retaliation. Tesla solar installations have caught fire in the past, notably atop several Walmart stores. And Hinkes said through his lawyer, there continues to be a real threat of fires due to serial defects in the Tesla installations. The consumers have not been adequately informed of the risks. Oh, but Reverend Elon is saving the planet. These things are risky. They happen. It's okay. Whistleblowers are bad. They're just jealous. But it seems that Tesla has another expertise in explosive making. Perhaps they should be a defense contractor. Should we add another $100 billion to the valuation of Tesla based on quote-unquote explosions optimism? Oh, and Reverend Elon Musk also got in trouble with Bernie Sanders. Bernie Sanders tells Elon Musk to focus here on planet Earth and pay more taxes rather than spending his wealth on space travel and all of that crap. And of course, the Rev responded by saying, I am accumulating resources to help make life multi-planetary and extend the light of consciousness to the stars. What kind of drugs is this guy taking? This is his ambition from becoming wealthy? And what is it with these billionaires? The moment they become ultra-rich, they become space assholes. All of a sudden, they want to go to space and explore Mars and the moon. Moving on to more EV news. What about Rivian? They're planning a network of 10,000 electric vehicle charges in North America by 2023. Once again, is being a psycho a requirement to become an EV executive these days? I don't know what they're snorting, what they're smoking, but they're all giving these outlandish, fugazi predictions. Oh, by 2020, we're going to have robo-taxis. By 2023, we're going to have 10,000 electric vehicle charges. How about we pay Hindenburg Research to investigate this one? And what's going on with Jeep? Jeep just unveiled its long-awaited Grand Wagoneer SUV topping $111,000. And if you're going to buy it as an NFT, you'll pay $120,000. This is the most expensive piece of garbage I've ever seen. But here is more from Jeep. They're also sacrificing their most sacred product, the Jeep Wrangler. Jeep unveils all-electric Wrangler concept SUV. I think we should add another $50 billion to the valuation of Jeep based on EV optimism. What about NFTs? Here is Twitter/Square CEO Jack Dorsey, and he sold his first tweet for $2.9 million as an NFT. But perhaps the buyer should use something other than Square to pay for his new NFT, because here it is, Square Cash App vulnerable to hackers, customers claim. They are completely ghosting you. Without warning, hackers drained every dollar of cash, stock, or Bitcoin out of accounts linked to Cash App, Square's popular payment platform. 6 of its customers told Yahoo Finance. Cash App functions as a substitute bank for many of its more than 36 million monthly users. I had to sell my car seat that I just bought for my baby that I'm going to have in a couple of months so that I could feed my kids because I have no money now. Shania Jensen, 24, a Cash App user from Utah, said about her account shortly after it was drained of nearly $3,000. And of course, we know who's accessing your digital wallet and stealing all of that cash. Moving on to Krispy Kreme. Yes, Krispy Kreme, what's going on? Well, they're offering donuts for those who can give a proof that they got vaccinated for COVID-19. You know, the government has been trying to encourage us to take the vaccine, and they thought about incentives, such as offering $1,000 for every American who takes the vaccine. But then they realized that we are already flooded with cash. Cash is coming out of our ears, and therefore we're gambling on our Robinhood apps. So what we need to incentivize us to take the vaccine is not money. It is donuts. All of these anti-vaxxers, once you dangle a donut in front of them, all of a sudden they will rush rolling their own sleeves to take the shot, because we are a fat nation after all. Now, if Krispy Kreme offers that donut as an NFT, then we will volunteer not just to take one vaccine, but all of them combined. Give me the whole thing. Pfizer, Moderna, Johnson & Johnson, no ice. Moving on to the heat map analysis. Let's see what's going on here from a daily perspective. What happened? Selling off the winners in energy, financials, materials, industrials, and buying the laggards. Technology, healthcare, communication services. But the picture is not that simple, because we're seeing some algorithmic trading based on the movement in the 10-year Treasury yield. We also have inflows in the bond market and portfolio rebalancing. That in itself triggers short covering activities in some of the beaten up names like Tesla, the software names, semiconductor names, and you see them outperforming today. And of course, what's going to happen if yields snap back higher again, you will see the opposite picture. Let's check on the themes for the market today, starting with the reopening stocks. We have declines across the board, and I told you that I'm starting to become bearish against these names because they went ahead of themselves and there are no guarantees that we will have a perfect reopening. The virus remains unpredictable. What about the inflationary trade? Mixed picture, but negative overall. Once again, profit taking here in anticipation that yields could retreat at least in the short term. And is that benefiting the de-inflationary trade? Yes, it is, but just slightly. Modest gains across the board, and you saw these names closing well below the highs of the day, signaling lack of confidence in the bounce we saw in the market for these names today. For me, the playbook remains the same. Anticipate buying the dip in the inflationary trade and anticipate fading the rip in the deflationary names, specifically the Mania names. But you gotta let the move take its course. You don't jump right away because there could be more gains to come for the deflationary trade or more pain to come in the inflationary stocks. So you have to let the move take its course. And the reason why I'm sticking to the same playbook is that nothing changed regarding yields. Yields are still elevated and the trajectory remains higher absent of any policy enacted by the Federal Reserve. Moving on to the charts analysis, starting with the SPY 15 minutes chart. We talked about the series of higher lows. And once you break that, you become bearish on the SPY. So what are we seeing from a 30 minutes perspective? Here's what's going on. It is a bear flag formation that should lead us lower. And we do have two support levels to look forward to. Number one, the 391. If that doesn't hold, and it shouldn't hold if it is a bear flag formation that would play lower, we have to look for 386 for the next support. And again, the S&P 500 is dependent on an overall performance from the broader market, not just technology. The SPY needs financials, energy, industrials to outperform. It needs the majority of the sectors of the market outperforming to rally. And what about the daily perspective for the continuous contract of the S&P 500? We have the resistance level of 3,960. That remains the obstacle for the S&P 500 to pass. Now, is it an easy target? Of course not. We got rejected there not once, but twice. Now, here's the important take regarding Treasury yields. If Treasury yields collapse lower and we see a sizable decline, then we will see the technology sector of the market and the Mania names outperforming significantly, pushing the Nasdaq and the S&P 500 higher. On the other hand, if yields continue to surge higher, then the technology sector of the market will suffer. Meanwhile, we will see energy, financials, industrials outperforming, pushing the S&P 500 a little higher. The worst case scenario, in my opinion, for now, for the short term, is if yields consolidate at these levels, not moving significantly higher or lower, because that will shake the confidence in the technology bounce, because whoever bought the dip will start to think, hey, wait a minute, yields are still elevated, and that is a risk if they shoot up higher again. And that would throw cold water on the Nasdaq bounce today. At the same time, parking yields at these levels will also be cause of concern and profit taking in energy, financials, industrials, materials, the cyclical/inflationary trade, because they will start questioning what if yields topped and we will head lower from here. Then we have to take some profits. So once again, moving higher or lower in yields significantly will give us clear directions. But parking yields right here will be a cause of confusion and bad momentum for the market. Moving on to the Qs. 15 minutes chart. Gapping higher, escaping the level of 313, and you thought you could do that easily without any punishment? Think again, because the close was a little weak. And the rational conclusion here is you're not gonna gap over 313 like this and maintain the movement. It acts like gravity. It will pull you back, so you have to run as fast as you can. The Qs need another gap higher tomorrow, not later in the week, not the day after tomorrow. Tomorrow, it needs to gap higher to once and for all escape the gravity of 313. And you will do that by capturing the support of 323. That didn't happen before, and therefore you saw the gravity of 313 pulling the Qs back again, back again, back again, and it will happen this time around too if the Qs don't gap higher by tomorrow and capture 323 as support. And what about the daily chart for the continuous contract of the Qs? Once again, the target remains the top of the reversal candle, which happens to be right around the purple trend line. That will prove itself to be a very, very difficult resistance to pass. And therefore, I am still doubtful about this bounce we saw in the market today. specifically in the NASDAQ, I'm calling a dead cat bounce because the resistance at the top of the candle, the reversal candle, and the purple trend line is very, very strong. It is almost impossible to break above this level of resistance without a bigger momentum, larger volumes, more participation in the options market. These are the conditions that will allow the Qs to rally again. And they're not happening. We're seeing the Qs rallying on pretty much lower volume when you dig into the specific names that led the rally. What about the IWM? 15 minutes chart. We talked about the bull flag within a bear flag. 15 minutes, you see a bull flag. 30 minutes, you see a formation of a bear flag. The longer range charts are always supreme and always more important. So you saw the Russell sliding lower again. And we talked about this particular ETF becoming a meme ETF due to the weighting of GameStop on the IWM. We are expecting a massive move in GameStop stock after earnings, up or down. So the next direction for the IWM remains dependent on the outcome of GameStop stock. Can you imagine that? We are talking about the Russell 2000 here, ladies and gentlemen, but this is what the video game market looks like. What about the Dixie? Once again, the resistance level of 92 remains very difficult to crack above, and the Dixie is facing rejection after rejection after rejection. It is hanging around there, trying over and over and over again, so it doesn't look like it gave up the fight, meaning that we have to give the dollar index the benefit of the doubt that it will be able to crack above 92. Until and unless we see a sign of exhaustion, giving up a big reversal candle, indicating that the dollar gave up the fight with 92. What about gold? I am leaving the Fibonacci levels from yesterday in the gold's chart because we want to track how far gold will bounce to. So far, we are facing a little bit of resistance here at around the levels of 1740. Now, if the dollar index rallies higher, cracks above 92, then the level of 1740 will be the top for this bounce and we will start trending lower. Mind you, of course, that if yields start to blast higher once again, that would be negative for gold. Holding gold right now is not a good idea at all because you have two headwinds working against you, the dollar and yields. We're not even factoring Bitcoin. Speaking of, what's going on with Bitcoin? Remember we talked about the bear flag formation, the possibility of that playing downward. We're starting to see that. It is not bearish yet, but it's starting to look like it. And you know Papa Jerome is going to stab you in the back. So perhaps this is the time when you hit the parachute and you jump off the tulip. I don't know. Moving on to the TNX, 10-year Treasury yield. Once again, we are seeing a formation of a bull flag, which is supposed to play higher until and unless we see a reversal candle, the trajectory for yields remain higher. This series of bull flags has to end before you call the top. For now, we have no indicator whatsoever pointing for a reversal in yields. What about bond prices, the TLT? We talked about 134.5 in yesterday's video. You have to watch that very closely because trading above 134.5 will give the NASDAQ the permission to rally because yields will stay stabilized. So this is what we're watching for throughout the week. How will the TLT be treated by 134.5? Because this is yet again a center of gravity for the TLT, just like the 313 level is for the Qs. You're not going to be able to pull way higher before gravity pulls you down. 134.50, you got to watch it. If we see a reversal going back to 134.50 and cracking below it again, you know that the bounce is over and yields will explode higher again. We talked about buying the dip in the inflationary trade and fading the rip in the technology and high growth mania names. But we said, wait, let the move take its course and be ready when you have to deploy your guns. You deploy your guns when you see the TLT failing to recapture the support of 134.5. VIX, what's going on here? Once again, a massive red candle, a massive reversal all the way back below 20. Now, given the market conditions, every time the VIX dips below 20, I am buying calls on the VXX or puts on the SPY. It is the same thing because right now we don't have any indicator that the VIX should be closing below 20. You close below 20 if you have a massive rally in the stock market coming up. You don't close below 20 when you still have concerns about yields, inflation, and good news becoming bad news. What about the big kahuna, Apple? What's going on here? As Apple goes, so will the Nasdaq. Apple goes higher today, the Nasdaq goes higher. It is the battle between 120 and 125. The ping pong going back and forth in purgatory. And at some point, this game has to be over. Either 120 will win. What is 121? 120 wants to pull Apple below this level. 125 is saying, come on, keep going, keep climbing. Here's a ladder. I'm trying to help you out. I'm trying to give you some support. But is Apple strong enough, fit enough to climb all the way to 125 without falling again? What is the difference this time around than the times before when Apple failed to climb all the way to 125? Perhaps the stimmy money, buying Apple, buying call options in Apple could be. How about rebalancing? That's another reason. But all what you have to watch for is 125. That is the ultimatum. Closing above it, Apple will go positive, and so will the Nasdaq. The bounce is not over yet, so long as you recapture 125. And this has to happen as soon as possible because 120 is the center of gravity in this chart. What about Tesla? 15 minutes chart. We talked about 679. You gotta recapture 679 and close above it to have any hope of pushing this chart higher. Well, we did that today and it all looked hunky-dory until we got to the last 15 minutes of the show. We saw a big sell-off closing below 679. This is not good for Tesla, and it shows a lack of confidence, even from those who bought the dip today and are holding the stock. They are not believing this move, and they're taking profits quickly. And here are the Fibonacci levels. Again, it says 678.25, 679, it doesn't matter, close enough, but this is an important level. And Tesla is closing below it once again. That's not good. If we have a confirmation of a downward move once again in Tesla, I will start shorting again by buying puts. I want to see how the chart reacts once it closes the gap between today's activities and last week's trading activities. You see the hammer, the green hammer? There is a gap there between the two hammers, the green hammer and the red hammer. The gap has to be closed, and it will be closed, and then Tesla should bounce higher. Keyword should. If it doesn't, that is the moment when I'm gonna place put options once again against Tesla. And here are two bonus charts for the day, starting with Square. I issued a tweet today saying that Square looks like one of the weakest charts in the market right now. What do I mean by that? We had a clear, defined trend line. We had a series of higher highs and higher lows, and that is broken now. We made a lower low, and we made a lower high. We also broken the support of the trend line, and it's starting to look very, very bad here for Square. Furthermore, here is the weekly chart. What do you see here in the weekly chart? A bear flag formation, breaking the trend, and the momentum indicators, the MACD dipping into negative territory, creating red impressions in the histogram. Likewise, the RSI has a lower divergence. All the signals and the indicators pointing out that Square will start to dive lower. And therefore, I bought put options today, and my expectations are that we will go all the way back at least to 197. That would be the support, and then we'll take it from there. And what about ExxonMobil? Fibonacci retracement levels. We stopped at the resistance of 62.5, 62.60, and now we're back all the way to 55.7, which is the Fibonacci level. Now, the momentum remains positive for energy stocks due to the rise in yields and inflationary expectations. So the dips are to buy in these names. And right now, since we stopped at 55.7, close enough to the retracement level, I bought some call options, expecting a bounce. The risk versus reward is worth it for me at least, and therefore I took the shot. Moving on to conclude this video, what do we have tomorrow? We have GameStop's earnings. That would be very important to watch. And we have throughout the week, not just Papa Jerome, but also the godmother herself, Janet Yellen. They will be speaking throughout the week. And we have about 21 speeches and appearances of policymakers this week. So expect the market to be very jittery at this point. Of course, they will try to pump the market higher, but we've seen them before sticking their foot in their mouth and not helping the market to go higher at all. But that is one thing to watch. And before I leave you, let's end with some good news, some positive news, because everybody accuses me of being negative and a Debbie Downer. So here is some positive news for you. COVID cases rise across more than half of the US as the country races to vaccinate. Oh, I'm sorry, this is not good news? Wait a minute here. I thought that you bulls want the market to go higher. Well, remember, bad news are good news for the stock market because they will push yields lower and the market would rally. Isn't that what you people want? You want the market to go higher? Then start cheerleading COVID, 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 because that is the only avenue for the bulls to rescue the market if COVID goes out of control again, because that will delay the reopening and it will push yields lower. And of course, it is a very possible scenario. And therefore, I am turning bearish on the reopening stocks. That's all I got for you tonight, and I will talk to you again tomorrow.